Is the stock market crash just around the corner? It's the one question that everybody seeks answers to in times of economic uncertainty in order to give them an edge when it comes to preparing themselves and their investment portfolio for the inevitable. And whilst I'm in no means a position to predict what will happen in the short term, what I can do is simply share some research in which I've done with you guys in order to kind of best inform you of the possible scenarios and possible situations which may play out over the course of the coming months ahead. So in this video, I'm going to present to you guys two different scenarios which could possibly play out, but I also want you guys to let me know down in the comment section below what you think will happen in the stock market over the course of the coming months ahead too. So those two scenarios being, during the months of September and October, the market will fall in value. The second scenario being that markets will continue to rise despite high levels of inflation, making future valuations less attractive. So we've certainly got a lot to unpack here, guys, but before we dive into it, my name is Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below. As well, drop a like on the video, guys. Really helps out the channel. That being said, let's talk about scenario number one. So let's first tackle the elephant in the room here, which is the potential of another stock market crash. It's a scenario that makes most of us feel uneasy about the potential of our investment portfolios significantly falling in value. It's a scenario that mainstream media outlets are now predicting, spreading more fear and uncertainty, and you've even got some of your favorite stock market investing YouTubers posting about the possibility too. But what is the likelihood that the stock market will crash or even just go into some kind of correction anytime soon? Well, historically speaking, September is actually the worst month for equity markets. As it says in this article, August is typically a weak month for stock market performance, and September is the only month that, on average, is worse for equity market prices. Statistically, September has always been a bad month for stocks since the 1950s, and stocks have always been known to decline in September. The S&P 500 has fallen in September 55% of the time since World War II. Since 1928, the S&P 500 has on average lost about 1% in September, making it by far the worst month for stocks. And as you guys can see from this chart, the Dow Jones Industrial Average during the month of September is by far the worst performing month on record since 1896. And on a similar note, in a separate article, the S&P 500 has also performed historically poor between the years 1950 to 2019 during the month of September and October. And in actual fact, whilst we're talking about history, if you guys were around on this channel roughly about this time last year, you'll know I posted about this concept about the month of September being a potential worst month for stock market prices. And as a result, I called out that during the months of September, we could see the stock market fall in value, which it did during the month of September and October last year, the market declined in value just shy of 10%. So the question that I have for myself, as well as all of you guys watching this channel this year, will we see the same fate again? Well, based on the current market sentiment, which is down about 1.5% in the past week alone, could this be the potential start of a fall in market value during the month of September? Well, the truth is, I'm really not sure. I'm certainly not the next Warren Buffett, but what I will say based on historical data, it looks like a pretty likely scenario. It could be in the realms of about a 10% market correction like we saw this time last year, but if I'm honest, I'm not suspecting that we'll see a stock market crash because it just doesn't look like, it just doesn't feel like it's on the cards just yet. But I certainly wouldn't be surprised to see the stock market fall in value just a little bit, driven by the fact that it's so overheated right now. And one thing that I certainly will call out is that during times of economic uncertainty and stock market uncertainty, investors from an investing philosophy standpoint typically pull their money out of equity markets and look to put their money into more safe haven assets like gold. The rationale for this is because gold as an asset class typically preserves the value of your money. And as you'd probably expect, with stock market prices typically performing pretty badly during the month of September, on the flip side, gold prices on the other hand usually have their best months during the month of September. So it's interesting to see companies like Palantir Technologies, who have most recently purchased $50 million worth of gold bars as a hedge against any kind of uncertainty that could affect the value of their growing cash position. So we are certainly in interesting times, but then on the flip side, there's also arguments all out there in the media that say that the stock market could continue to rise in value regardless of all the kind of stock market uncertainty being in a bubble, as well as all the economic uncertainty too. So forget about the stock market volatility that we may see throughout the months of September and October, because a lot of analysts out there, or some analysts out there should I say, are certainly predicting that the stock market will continue to climb in value for the foreseeable future. You've got major banks like Goldman Sachs who came out at the start of August predicting that a further upside to the tune of about another 7% before the end of the year. The rationale being the combination of higher than expected S&P 500 earnings and lower than expected interest rates drive our upgraded price targets. And look, earnings have been pretty solid recently, especially for the stocks in which I've personally been looking at, as well as the stocks I'm invested in too. And whilst the Fed continues to keep interest rates flat, you can probably only expect that the stock market will continue to rise in value. And as Goldman Sachs says, one of the drivers for high earnings is relative to consensus. We expect stronger revenue growth and more pre-tax profit margin expansion as firms successfully manage costs and as high-margin tech companies become a larger share of the index. As we all know, tech stocks make up a pretty significant portion of the overall S&P 500, and with these big tech firms becoming even more profitable, they will certainly be driving the overall value of the index up higher. Even if you think about some of the companies in which I'm personally invested into and their most recent quarterly earnings reports, we've got the likes of Apple, who recorded a net income which was up 93% year on year. AMD's net income was up 352%. Facebook's net income was up 101%. Amazon's net income was up 48%. And Tesla's net income was up 998%. So earnings growth figures are extremely high right now, and with continued low interest rates and with a low interest rate climate, as well as what looks like unlimited quantitative easing, I'm kind of not surprised that some analysts think the stock market will continue to head higher. I guess the only real concern that I have for my own investment portfolio is if the tides change and the Fed looks to increase interest rates, quantitative easing stops, and the US economy is no longer being kept afloat on a government bank book, how much downside exposure will I potentially have? And the truth is, well, I'm not really sure. Now, one person that could possibly have a large amount of downside exposure driven by the high risk nature of her investment portfolio is Cathie Wood, the CEO of ARK Invest. For those of you guys who haven't heard of Cathie Wood before, she essentially invests in disruptive innovation, as she calls it, and in essence these are companies that are high growth stocks that could massively disrupt the industries in which they're in. Now, based on the wider macroeconomic conditions in which we have right now, you'd probably expect that this is not an ideal time for the likes of Cathie Wood or her investment strategy. And you'd probably be right, because her flagship ETF, the ARK Innovation ETF, is down 7% year to date, whilst the S&P 500 on the other hand is up just shy of 20% so far. But despite this, Cathie Wood still remains very, very optimistic on the investments in which she's made, as well as the broader stock market conditions too. And despite every macroeconomic indicator pointing towards that we're in a stock market bubble, like the Shiller price to earnings ratio as an example, Cathie Wood on the other hand is still very much insistent that we're not in stock market bubble territory. She said in a recent interview, "I don't think we're in a bubble," which is what I think many bears think we are. In a bubble, and I remember the late 90s, our strategies would have been cheered on. You remember the leapfrogging of analysts making estimates one higher than the other, price targets one higher than the other. We have nothing like that right now. In fact, you see a lot of IPOs or special purpose acquisition companies coming out and falling to earth. We couldn't be further away from a bubble. And look, perhaps the sentiment has changed from investors since this point in time. Perhaps the sentiment of investors is to be a little bit more cautious now than they were back in the late 90s and the early 2000s when we saw the dot-com bubble burst, which is possibly the reason why the sentiment isn't quite aligned to that in which it was about 20 years ago. However, Cathie Wood goes on to say, "When I see such negative sentiment out there, especially when it comes to valuation and longer time horizons, investment time horizons, I actually feel a little bit more comfortable. I like bad news. The discounting is worse now than the news actually will be. I actually feel better in that environment for our strategies." So look, Cathie Wood certainly has balls of steel when it comes to the current stock market conditions in which we all find ourselves in. She certainly doesn't believe that we're in a stock market bubble whatsoever, and it looks like she believes the stock market will continue to rise in value regardless of what every other macroeconomic indicator is currently pointing out. So it's an interesting predicament that us as investors find ourselves in right now. You've got some analysts suggesting that the stock market crash, as and when it occurs, will be the biggest one in stock market history. However, on the other hand, some analysts are certainly predicting that the stock market will just continue to rise in value. But be sure to let me know down in the comment section below what your thoughts are on the state of the stock market and whether you believe that we'll see a stock market crash anytime soon, or whether you're on the other side of the table where you think the S&P 500 will simply go up in value regardless. Now, if you enjoyed the video, guys, all I ask is that you drop a like on it, as well subscribe to the channel if you're new around here. And with that being said, I'll see you over in the next video.